Hey Rand, how's it going?
Good. Thanks for having me, Alexej.
Super excited to have you. I was really looking forward to this episode. So yeah, amazing. Awesome. Well, look, I mean, I read your book. I saw you at the conference. You're one of the basically unspoken, almost heroes of the startup SEO and also SaaS world now. So lots of questions for you, and I think the audience will love this podcast interview. So let's maybe start with a quick introduction from yourself for those who do not know about you.
Sure. I assume you want a professional introduction. So let's see, my first company was a business called Moz, which was initially a consulting business and then became a software business that was in the SEO, search engine optimization space. I ran that company for many years, raised lots of venture capital, I think maybe $30 million or so, and grew it to $50 million a year and tens of thousands of customers, a few hundred employees, mostly here in the Seattle area. And then I left that company in 2018 and started another company, also in SaaS software business, but no venture capital, very, very small team and company called SparkToro. Today, SparkToro is about $1.5 million in recurring revenue, but only 3 people and no institutional investment. I also run a second company called Snack Bar Studio, which hopefully when by the time this episode airs, the funding process will actually be complete. But that company raised just about $2 million, also non-venture, exclusively from angels with a unique structure. And it's in the process of making its first game. It's an indie video game studio that, hopefully will have lots of promise for the years ahead.
That's cool. That's cool. So let's maybe start with the first topic around raising from non-VCs, right? And I guess when somebody tries to think of a startup, they usually think of TechCrunch or some big headlines. Hey, this founder raised 5 million seed or whatever, 20 million Series A. And obviously we kind of live in a world where media really glorifies big numbers, big raises. And I think what a lot of founders do not understand is that this money comes with a price, and the price is usually, a pref stack. So, shares of a very different kind than you own as a founder, which have, for example, certain conditions attached to them. And then, a board above you, and basically, the potentially high probability of you basically being, getting rid of your job, so to say, as well, or being, fired from your job as a founder even. And obviously, as you said, right, you raised 30 million, almost plus or minus from VCs. And then the new business you're building on one of the two, but SparkToro, you raised around 1.3 from non-VCs, mostly angels, and I guess maybe some family offices there as well. And you can kind of call a really big angel, you can sometimes call them a family office as well. But I guess and obviously, again, you explained a lot of these things in your book, but what made you go down, specifically down the route of saying, hey, instead of me going down the route of VC money again, which you could have done really easily, you've gone down the route of angel money, right? Which probably is harder in terms of you need way more investors in your cap table. And you will hear more about it, having now built a business and already returned all the investment people gave you, right? Obviously, you already, made so many more investors happy or even more happy than maybe previously. But maybe tell us, why did you choose this route this time over the other one?
Sure. So a large number of reasons, but I'll say that personally, I don't love running big companies, and I don't have a particular interest in low probability types of businesses. So I am not a good match for the venture asset class because I don't want to be one of, 200 or 300 people in a portfolio where 5 companies will succeed and 295 companies will fail. And I don't just mean fail like they'll go bankrupt, although many will, but they'll fail to return their sort of investment return minimum. And so those 5 companies at the top of the portfolio have to make up for the 295 that failed. And this structure of sort of winner take all produces monopolies, which I don't think is good for the economy or the world or politics. Anybody who's looking out there now and is like, gosh, there's some real weird people in the venture ecosystem who are putting money into real strange places in politics. Yeah, man, that's because guess what? They're doubling down on their nefarious power and, saying that, just spouting all sorts of strange theories about how the world should work. And also, as a founder, I think what every founder needs to realize is that you are going to think of yourself as very special, but the world of venture really doesn't care how extraordinary you are or how good you are at your job. There is a tremendous amount of luck and forces outside your control that will influence, if not dramatically affect your journey. And I don't like those either, right? I like the ability to control my own or my company's destiny. I want the ability to say, that company didn't do well, and that's my fault entirely, or that company did extremely well, or anywhere in the middle, and that is the result of the team and the decisions we made and the work that we put in, not, well, we were on this path, but then, our venture fund that had put money into us initially in order for us to raise a second round, they wanted to see these metrics. So we went toward those metrics, which weren't the right thing for customers, but we had to do it to get our second round done because we were bleeding money because we were trying to grow at a rate faster than we could keep up. So it's just an ecosystem where the incentives do not align with build a great product that customers want and market it to them and sell it to them in the ways that they want. I just want to do that. I think most founders just want to do that. And I think very few institutional investors will set you up for that kind of success. Very few outside owners will set you up for that kind of success because portfolio theory demands different things. So for that reason, I did not ever want to raise venture again. And Alexej, you say, hey, Rand, you could have easily raised, from venture capitalists again. I don't mean to call you out on that, but after I published Lost and Founder, which many people have referred to as sort of the anti-VC startup manual, I remember getting a few emails. I had a phone call with like one investor and they were like, you'll never raise money again. No one would ever fund you after this book. And I was like, yeah, that's kind of the idea. I'm okay with that.
Yeah. Fair enough. No, to be honest, I think it's almost the theory where the more you reject people, the more they want you, right? So I think if you would say, oh, I'm actually open for VC money, I think you would have a queue of VCs out there trying to invest. But I mean, all great points, really. And I think like one of the points you made is, okay, if you raise VC, you rather be certain about this huge outcome. Otherwise, you might not make any money from a personal wealth perspective. And equally, the odds are really against you. And VCs play a game of having hundreds of these companies in their portfolio, and so they actually spread their risk versus a founder has, let's say, only one life and sometimes only one chance.
I mean, Alexej, I'm sure you know this. They take a management fee, right? So the overwhelming majority, I think it's 75 or 80% of venture funds fail to return their investors, their LPs' minimum return requirements. But it doesn't really matter because if you raise $300 million and you're getting a 2% management fee, guess what? You win. You are making tons of money, whether you never take a meeting with a startup, whether you never invest $1, whether every one of your investments fails, you still clean up with the, what is that, $6 million that you make from your $300 million fund every year. It's a sweet deal, right? And I think that, VCs would try and say like, no, we work really hard for that money. No, every janitor works harder than any VC. Every single one, I guarantee it. The person who's the assistant coach at your high school, they're working harder than any VC has ever worked in their life. And I'm tired of playing this game of, investors work so hard. Even founders, I have never worked in my grindiest 80-hour weeks where I was trying to, make Moz get from 20 to $50 million. Never did I work as hard as, the guy who has to deliver my DoorDash.
100%. And, during the time when I was investing in VC funds and also direct investments at the family office in tech companies, I mean, the average returns, as you said, of VC funds are actually way below average of all asset classes out there, right? And I think like there was this time of a certain vintage, and if you're in the top tier VC, yes, you can make that 30% IRR. But otherwise, it's a really pretty bad asset class to be in. So going back to all the reasons you listed for not going down the VC route, right? And the way you went down the, let's say, angel route. And you basically mentioned that you wanted to build a business which might not have that 100x potential, but could still be, a big and good business, right? Now, most of the angels I know would say, well, it's still early stage tech investing. It still has this downside of like complete loss of your like the investment, right? Basically, your whole like investment can turn to zero. Therefore, I want that at least 10x, return profile. What did you tell them? I mean, obviously, again, you have a 17-year track record of being a CEO and founder, and you've basically built a product for a very similar audience. Moz was like, I mean, even a bigger audience now, let's say, but still, let's say, to marketeers and content people and like head of growth, etc. If it would be somebody else, without 17 years of track record, without building, let's say, product for a very similar audience, how could they justify getting that angel money without offering that 10x plus return?
I don't, realistically, I don't think that they could. So a few people, folks might not know, I don't know if your listeners know, Alexej, but we, SparkToro, put our docs publicly. We made an open source version of our documents that we used for fundraising up on the web. If you Google SparkToro funding, you can go download those and give them to your lawyers and use them yourself. A good number of companies and a few funds, like Tiny Seed Fund, used SparkToro's docs as basically the inspiration or the structure for their investments. And some of those companies have done quite well. In terms of returns, some of them have done well in terms of raising money, but notably, I think every single founder I've talked to who's used our docs or a similar structure has had significant experience, expertise, and reputation in their field. So, for example, a friend of mine here in Seattle is in the hardware business, culinary hardware, in fact, and he was the creator of the first home sous vide machine. He worked at, a number of impressive local culinary technology companies. And then he started his own. He used the SparkToro structure to raise money from, I think, about 30 angel investors, raised a little over $2 million. And, was sort of off to the races, but couldn't have done that if he was not a notable figure in the culinary world with lots of connections and lots of relationships and a, long history and a reputation. I think that's actually relatively healthy. This is no offense to the 20-somethings who, like me, drop out of college to pursue their startup. But I don't think that's the best model. When you look statistically at the numbers, you see that founders who start companies in their 40s and 50s and 60s are dramatically more likely to produce sort of market-beating returns than those who start companies in their 20s. They're less likely to produce billion-dollar unicorn outcomes, but I would argue that what the style of investor that I raised from, that my friend Scott raised from, that Tiny Seed's raising from, those types of investors are looking for, hey, is there a lower risk way to get into the startup world? Because Alexej, let's say you and I formed a little fund and maybe we each contributed, I don't know what your finances are like, but let's say we each contributed $1 million to the fund, which is a lot of money for like an individual person to put into, private startup investing. Maybe we could put $100,000 into 20 companies. Well, that's not a big portfolio. Portfolio theory at venture scale starts to work around 500 companies. We're at 20. How are we ever going to get there? Like the only way it can work for our fund, right? For our tiny $1 million fund is if those 20 companies have a much lower rate of failure. A lot of them at least return the money that we invested, and some of them make 2x, 3x, 4x, maybe one or two make 10x. That's amazing, right? That really makes up for a lot of failures. But in most of the cases where you're putting in a lower risk portfolio or money into a lower risk scenario, you are not aiming for those billion-dollar returns type of scenario. And so you're looking for stability. This is why SparkToro's structure, which I used for Snack Bar Studio as well, both of them do the same thing, which is after the company becomes profitable, the first thing it does is pays back the investors their original investment. And that's when founders can start to make money too. Because of that, the entire focus of the company is how do we get to profitability and stay there for a long time? Not how do we become a billion-dollar company or die trying. And the venture capital incentive, in my opinion, is what kills so many companies. It's what makes for those low odds because you have to chase these insane metrics to get your next round of funding, to get your next investors interested even, to get meetings, to continue on the journey. Whereas, hey, you want to take $1 million and build a business that can produce $1 million a year, that is much more reasonable and possible.
Okay, makes sense. And yeah, I think like what you also said, fundraising should actually be harder than it is, right now. Maybe right now it is actually hard because of, macro sentiment, right? But like obviously 3 years ago, it was super easy and it should not be that way, right? And I guess one thing which, it's a really good point you bring it up in terms of the terms you created and yes, open sourced, you basically have this return of initial capital as a condition to the way you raise. And that might sweeten the deal to angels who basically say, well, it won't be a 10x return, but equally, I might not lose all my money.
Yeah, right. So with SparkToro, right, our angels got their money back in 5 years. So basically they invested in 2018. Last year we paid them back. Maybe it's 4.5 years. And because of that, the way that they might think about it is, let's say they were looking for a portfolio level rate of return, maybe 6%. Can you beat a 6% compound interest rate of return? And so once the money's returned to them, it's only really the 6% for the 5 years, right? That they've lost and that they're now trying to beat. But they still own, I think in the case of SparkToro, they own about 25% of the company. In the case of Snack Bar Studio, they're going to own about 33% of the company. In my friend Scott's case, they own about 20% of that company. So, it's you still own that shares in the business. Sometimes the business plans to pay dividends as well. So an exit is not your only opportunity. In venture capital world, there's no dividends. No one pays you based on your shares. With SparkToro, that's exactly our plan. I think at the end of next year, we will be able to pay out a dividend. And so someone who put in $100,000 will get back another 20 or 25 grand. Phenomenal, right? Like wonderful for them. And they still own their shares going forward, and they'll get another payout in a few years and another payout a few years after that. That's our goal. And I think that this model of investing should exist for more people, because if it did, two groups win. One, startups that don't want to just chase the $1 billion. And two, investors who can't place 500 bets or even 100 bets. They can only place 5 or 10 bets or 2 bets. And they really need those businesses to aim to survive profitably.
Two questions about the terms, right? And you might have mentioned that in publicly, but what do you do, let's say, or what does someone else do if that person doesn't get to profitability, but there is an offer to acquire that business on the table, and the offer is maybe less than what the business raised, but let's say the founder decides, you know what, I tried, I'm a bit bored or whatever, I don't believe in that anymore. Would the other investors kind of get that pro rata then in that sense? So does it actually almost work like that 1x liquidation clause, except it's slightly different, but still some similarities?
Right. So for example, if SparkToro had not paid back its investors, and it sold, the investors would get the greater of either their shares pro rata or the amount that they put in. So let's say SparkToro sold for $2 million, which was less than half its initial valuation. Investors would have gotten their 1.3 million first, and then the 700K would be split pro rata between everybody else.
Okay, so it is basically like a 1x liquidation. So
it's very similar.
In actually a downside case scenario, you as a founder, you would still lose out, actually.
Yeah, it's not a $2 million sale, whether you're venture backed or backed by a SparkToro type of structure. It's not a great scenario, except in this case, which is, let's say today, Casey and I, my co-founder, we would never do this because SparkToro is doing quite well and we're very happy with it. But in the scenario where we looked at each other and we said, you know what? We don't see the future here, or we don't want to keep doing this, or, one of us gets sick, one of us has to take care of family, something like that. Because we've already paid back our investors, we could take a $2 million offer, right? We could say yes to that. Our investors would still get a win on top of the money that they've already made, and we would get a nice win, right? Because we own whatever it is, 75% of the business. So that money would be real for us. It would be a fine offer. And, obviously we'd be selling for barely over 1x revenue, which would be silly. But I think that's it opens another door and another path for founders that would ordinarily be closed. And in our docs case, once we repay our investors, they don't have veto power over a transaction like that.
So yes, the second question is actually on these, veto and other powers, let's say. So any of your investors who wanted, let's say, a board seat if they invested more than X, and what did you tell them?
There's no board. So SparkToro is an LLC for a variety of tax reasons. LLCs don't traditionally have a board of directors. Obviously, a C corporation does. And in the case of Snack Bar Studio, Snack Bar does have a board of directors, but I am the only member. And so that it does a couple of things that I think most private investors are actually quite happy about, which is you don't need to contribute your time. You don't need to feel like it's your obligation to have insight into the business and into the market and, come with an understanding of what's going on, come to a quarterly meeting, review documents, sign things. That's not how it goes. It is much more like a traditional angel investment that you might make on AngelList and just put in some money and then hope that it does well. we're closer with our investors than that because the overwhelming majority of my investors in both companies are people I know personally, personally talk to on a semi-regular basis. I send them updates every 6 months about how the business is going and what's going on with it. I ask them for help. It's a very collegial, camaraderie focused environment, but it's not, there isn't that feeling of obligation of, oh man, I need to put in my due diligence on this business every few months to make sure that I'm keeping up. And it's really about trust. So like we talked about earlier, if you have a reputation and you have a network and people know that, you're a capable person who's done trustworthy things in the past and can tackle this sector, it's a good match. And unfortunately, if you're just starting out in your, early stage in your career, or you're doing something that is way outside your field, more difficult. I actually think Snack Bar is a good example of this, right? I have run software companies all my life, and technically a video game is software, but it's a very different kind of software. It's B2C. It is totally different market, completely different customer set, sold in a different way, all of that. And so when I raised money for Snack Bar, really the pitch was, hey, maybe I'm a trustworthy person that and like, but it's the team that I built, the other four founders, co-founders, who are making good on that promise, right? One of them is Nicholas Kraj, who's a relatively famous game designer, did the Assassin's Creed series, was the lead game designer for that, and Just Dance, and the team, and a whole bunch of other big games that have gone on to have hundreds of millions, billions of dollars of revenue. So in that case, right, the promise is not just about me, but about the team.
Makes sense. Yeah, in my case, again, I also raised from non-VCs and family offices. I have one board observer who came along with a larger, let's say, syndicate of investors. But I kind of do, the quarterly investor update, and it, even the board observer meetings, let's say, which are no longer that regular anymore, but, they did serve me, let's say, a sort of accountability exercise. So boards sometimes can be helpful, but, sometimes people also overestimate the experience and the usefulness of VCs, who then promise you, oh, we have all these board members and we'll give you so much value add, right? That's why you need to take our money, and that's why we're so important. So,
well, and I would say you can provide that value without having to sit on a board, right? So plenty of our investors with SparkToro, super helpful. Yeah. There's no reason for
exactly. And you can have separate, option agreements based on milestones, right, etc., rather than give away straight away equity and basically also give them voting over your destiny, let's say.
Yeah.
In terms of the game you're launching, I guess, how many of the investors in that startup are already investors in SparkToro?
Not as many as I expected, to be honest. So we had 35 investors in SparkToro, and I believe 12 of those are also people who decided to invest in Snack Bar. So
basically a third, right?
about a third.
An amount then, right, basically.
Yeah, and Snack Bar obviously raising more money than SparkToro. It's a bigger team. It's a little more expensive project to build out. I would say I told all my investors who I pitched that it's a higher risk but higher reward business. Video games are very hits driven. We have lots of ways that we hope to mitigate risk, but there's no guarantee of in any company. But certainly, I expect that there'll be challenges along the way. I just think that in this case, I was surprised that so many people who basically got their money back from SparkToro and had seen how that company was doing. I was a little surprised, Alexej, that most of them, the majority of them, passed on. Snack Bar.
It's also sentiment, right? It's also sentiment right now. Macro is so different than before. I mean, I have the same, like right now, I talk sometimes to some investors saying, hey, we could acquire this company and, the valuation would be X. And they're like, huh, but that's a really high multiple. I'm like, well, we raised money at like 3 times that multiple before. And we've proven all this growth. But yeah, macro is everything, right?
Yeah. It's shocking to me how different it is, because my suspicion is that now is actually a much better time to start a company and get it off the ground, because competition is lighter. There are fewer companies being invested in. In the video game sector, for example, massive amounts of layoffs, tons of projects canceled, tons of studios shutting down. The last year and a half has been just awful in that field, which is why I think in 2, 3, and 4 years, all the game projects that ordinarily would be coming out will be much lighter. The number of games that will be available in any given genre from any given studio will be much smaller than it was over the last 3 or 4 years. So it's a fantastic time to be in that market. Your positioning is just so much better. But for whatever reason, right, investors don't see it that way.
Yeah, it's herd behavior, right? And I mean, it's just herd behavior, which is really frustrating. But I agree, right? Like building any type of business right now is easier. Talent hiring is so much easier than before, and you need way fewer people, right? Because productivity is much higher because of various AI tools and everything else which is happening.
Well, not so much in video games. I don't know if you're aware, but if you use AI directly, generative AI directly in your game, you will be banned from the Nintendo shop, the Xbox shop, the PlayStation shop, the Steam store. None of them allow it at all. And it's mostly because they fear the future in which a lawsuit could happen where, hey, this copyrighted material was used to train these LLMs, and then you sold $1 billion worth of games on top of that. You need to pay, all these people whose content was trained on it. And so they've specifically said that. Granted, you can still use, ChatGPT to help with the programming in Unity.
Yeah, and Copilot, right? And yeah. But we'll get to the AI topic in general. But maybe one other thing I wanted to ask you is maybe going back to the whole future of search, right? And obviously, you're the founder of Moz and SparkToro, aggregates a lot of search data and kind of like, customer interest and what they are looking for, a type of data. How do you actually see the future of SEO evolving in the next 3 years?
Next 3 years. Well, let's see. I think one expectation that I and many other people had over the last 3 years was that we were going to see a lot of activity that happened on classic search engines, Google and Bing, and DuckDuckGo, moving to AIs, right? I'll just go ask ChatGPT, I'll just go ask Bard or Gemini, or Claude, whatever. And that is not what's happened. So we did a bunch of research into this because we had this question ourselves. And so we have a clickstream data provider, Datos, who's got a giant panel of millions of people who've opted in, basically to share their click streams, all the URLs that they visit. And that data set lets us see, how many people searched Google in January of 2019 and how many searched in January of 2021 and 2024. And the numbers for Google searches per searcher are higher than ever. The number of users of Google search is higher than ever. And the usage of OpenAI, ChatGPT, which is the most popular of the services out there, is also quite high, but it is additional and it is not cannibalizing. People don't use AIs for whatever reason. I say people. I'm sure someone listening to this is like, I'm on the bleeding edge of tech and I've switched all my behavior over to Perplexity or, whatever it is. I see this in my LinkedIn feed all the time. But the data says you are alone in that. You are very unique and special. The overwhelming majority of human beings on this planet who use the internet have not changed their behavior in that way. In fact, they have only become more addicted to Google and Bing and DuckDuckGo. And very frankly, I think that is not likely to change in the next 3 years. I don't think there's going to be a next generation evolution of AI search. I don't think that Search GPT, for example, is going to suddenly steal away tons of market share. My guess is plus or minus 5% of what is currently happening with market share and Google is going to be true 3 to 5 years from now. It just doesn't budge. People are too wedded to the habit of Google. Google themselves is very frankly, they are incredibly good at serving up. I know people get frustrated with what Google responds with, but it's still a lot better than what you can get from other places because they just have so much historical data on what people click on.
Interesting. Yeah. So moving on to, let's say, the future of SaaS, right? And we discussed briefly, how AI, and maybe not in gaming as much, but in other areas, does increase productivity and, make life easier for so many people. There is this notion of AI, software eats the world, right? And then AI eats software. And, on 20 VC, I heard this quote that every VC who believes in, AGI shouldn't be investing in SaaS because AI will create any type of SaaS there is. And yet VCs are still obviously, investing like crazy in AI and like crazy in SaaS. So the first question, I guess, is, do you think that at some point there will be just, agents or, like a way you can like do a prompt to basically get all the outputs SparkToro provides right now as a solution?
Yeah, we've thought about this. Thankfully, so far, no. I don't. If that were to happen, what would need to be true is we no longer have generative AI based on large language or large visual models, but something new, like some entirely new form of technology, whether we call it AI or not, that is creating based on actual data, right? So the reason people use SparkToro to say, what websites do interior designers in Los Angeles visit, is because they don't want ChatGPT to give them the words that often come after other words when you look for interior designer in LA on the internet. You can do that for whatever 0.00029 cents, but that will also simply tell you most of the things that you could find from searching the first few pages of Google, right? It's essentially amalgamating the tokens that come after other tokens, in this case, interior designers, Los Angeles, and websites. Fine. If that's what you want, you go for it. You go to SparkToro because there's a large data set behind it of people, like real people who have said that in their profile on LinkedIn that they're an interior designer, and their behavior shows visits to these websites, right? And they want a confirmed, accurate view of that. This is very similar in the SEO field. So lots of people, Alexej, started when ChatGPT came out. They said, oh, what are all the search terms that people who are looking for an interior designer would search for? And ChatGPT will give you a list it looks credible and it's not terrible, but it's also not accurate in any way, right? Because ChatGPT does not have a data set of here's what people search for in Google, here's how many times, here's how many unique users, here's which terms are going up and down in popularity, here's which ones are easier and harder to rank for. They don't know any of that stuff. All they know is tokens appeared after other tokens.
Yeah.
So
yeah.
It's going to be very difficult for the current large language model system to replace a data set that people might want access to. As an example, Redfin or Zillow have access to all of the home sales in the United States, and they know by day and week and neighborhood and the multiple listing service. That data set is valuable on its own. And until an LLM, basically, you could put an LLM on top of that if you had it.
Yeah.
That's pretty similar to what Redfin and Zillow do. Great, wonderful. But then, okay, now show me all the photos from the real estate. No, I got to license that. Sounds like you have to build SaaS. Like any one of these solutions that you go down, you get to the point where you're like, I guess we should just build a SaaS to do that thing.
Yeah. So I think, what people, I guess, don't understand is that you've built all these API integrations, right? And you have relationships with all these parties, which allows you to get all this data aggregated on your platform, plus all the knowledge from your, let's say, brain and your team's brain, right? In that solution to basically give this like perfect, whatever UX, UI picture to the user, right? And of course, if there is AGI, you can still say, well, okay, look, give me all the best possible sources. And if that AGI, whatever, solution, if they have the API keys with the whole world, right? Then in theory, of course, there could be a solution like that, right?
But so conceivably, right, if if there's a future in which you say, hey, I want you, large language model, to go crawl all of these LinkedIn profiles and extract out all these things. Then I want you to go get all the Google search results for all of these. Then I want you to go find a clickstream data provider and I'll pay them and I'll get an API to them and I'll make the right requests. Then I'm going to put that data together into this format. You could build your own little mini SparkToro.
Yeah.
Fine. Totally great. Way more expensive than subscribing to SparkToro.
Yeah. It's just interesting how viral and how popular this belief is, right? Like, I don't know if you saw the Eric Schmidt interview, I think it's Stanford, right? Which got taken down. And he was actually basically, like big on this. Well, everyone will have their own agents and they can do whatever they want to do, right? Which is a bit extreme. Yeah.
As soon as we have self-driving cars and Hyperloop, I'll start to believe these like tech luminaries who say, hey, in a few years, we're going to have this. You know what we heard? I heard, I'm sure you did too, 2 years ago, who was it? Sam Altman, who said that 90% of marketers are going to be out of work by 2025. Like they just won't be needed. I don't know if you've looked around at the stats lately, but US unemployment is at a historic low. Marketers are very employed. Sam Altman only has 3 months left to get 90% of the 2 million people who work in marketing in the US fired. So you better get to work, buddy.
All right. Let's go to the final, let's say, part, which is kind of around this whole like notion of wealth building, right? And I think like a lot of people, and this goes back a bit to the kind of, first part of the podcast, which is, people raise money and people try to do a startup, not just because they want to maybe build a solution for a problem they're kind of itching about, but also about, creating this like big amount of wealth for them, right? And your approach where you basically say, look, we protect some of the downside for you, or like, most of the downside, to be honest. But we are very honest. We are going to work, 40 hours a week. We're not going to work 80, 100 hours a week. And we will, build a business which probably generates 3-5x your money, which is great, right? It's like private equity top tier funds returns over 10 years. And that's it, right? But then equally, because you're starting from such a small base, I guess like 3-4 years in now, you're at, let's say, 1+ million ARR, maybe more, right? Let's say current multiples, whatever. Let's give you 5x revenue, right? Like, let's say bullish, right? Yeah, it's high, but I want to be generous here, right? For the theoretical exercise. So let's say 5 million revenue, right? 5 million valuation at exit. And then some people will say, well, look, you gave away 25%. You have a co-founder. You're basically down to, let's say, 2 million proceeds. Plus, on top of that, you actually pay taxes. So maybe it's $1 million.
You do get QSBS.
fine. QSBS, whatever. Maybe some other countries are not so great about it.
Right, that's true. That's a good point. Yeah.
Yeah. So let's say fine. Let's say you pocket in 1.5 million after 5 years of work, right? Now one can argue, well, if I'm a VP of engineering at one of the big tech companies, in 5 years I make more money than that, and I still work my 40 hours because these big tech companies don't work that hard anymore, right? So I guess the question is, how do you build wealth, right? Because most people don't realize that building wealth is actually much easier over a very long period of time, rather than trying to get rich quick, right?
And the SparkToro model tries to account for this. Casey and I had this conversation. We were joking around about something, I can't remember, something expensive that Casey wanted to buy. And I was like, yeah, well, someday when SparkToro sells, you can get 10 of those. And Casey said, I can get one as soon as we pay our first dividend. I was like, you're right. Because Casey owns whatever, he owns 37% of the company. Maybe it's even 40%. So if SparkToro makes a $600,000 dividend payment, not only did Casey make his salary that year, he gets another, basically, more than double his salary again. And then in a couple of years, get it again and again. And then if the company does sell someday, even if it's for a low multiple, even if revenue is not that high, well, not only has he made his salary, he's also gotten this giant bonus, every few years based on ownership of the business. And I think that it very much rewards keeping a high profit margin as opposed to scaling up dramatically, right? And so Casey and I actually sometimes have this a little bit of healthy conflict, because I want to grow the business a little more and Casey wants to keep the margins really high. And so, there's that healthy co-founder tension. Casey's point being, hey, next year I want to pay a big dividend. And my point being, yeah, but in 5 years we could pay a huge dividend, which is okay, right? I think that it's good to have that tension between growth and profitability at any time, but it's not a scenario where either of us are frustrated that we don't work at Google or Apple or Amazon. Very frankly, Alexej, I don't think startups, especially our kind of startups, but any kind, it's not about the money, right? Everyone who gets venture backed, they're making way less than they could at big tech companies. Yeah. And 95% of them, 97% of them are going to fail anyway. They're going to make nothing more than their salary, right? Their stock or stock options are almost never worth anything. And so I would say they're in a much worse position than we are, right? We have nice salaries and we have this option.
I totally agree, except that 97% of the people who raise funding do not think they end at 97%, right?
This is like all the people on LinkedIn and Twitter complaining that if they make more than $100 million in unearned capital gains, they're going to be taxed under the Harris plan. And I look at it, I go, wait a minute. How are you? There's only 70 people in the US who made $100 million in unearned capital gains last year. Are you sure you're all one of them?
Yeah. Exactly. And look, I mean, it generally is about building businesses, not just startups, right? Like a lot of people who start agencies, right? They have a really healthy profit margin, pay themselves amazing dividends, and actually over time build up a much bigger wealth than most, let's say, VC-backed founders, right?
Plus, how do you put a price on doing what you want to do?
Yeah.
I love working with Casey and Amanda. I love working with Nicholas and Geraldine and Miriam and Francesco. I love making a video game. I love making this marketing software to help people understand their audiences. I love that I don't have a traditional 40-hour work week or anything like it. Today I'm going to the aquarium with some friends, at 4 p.m. I'm knocking off of work. I take very few meetings in my day. I have control and ownership over not only the relative success of my businesses, but also over the daily work that goes into them and the decisions around what we're going to do and not do. I cannot recommend that enough. And, venture capital backed startup world does not give you as much of that freedom as you might hope, but independent startups do.
So maybe to finish off then, let's say the future of entrepreneurship in general. Do you see the model where there will be way more entrepreneurs with, let's say, smaller businesses, but equally, do you see that there will also be more entrepreneurs with multiple businesses like yourself, right? And maybe you create in, I don't know, a few more years, a third one, right?
Sure.
Because the way you're running them might mean, again, they might not scale 10x or whatever in 3 years, but they all compound, and then you have the power of compounding, right? And then the way you run them is very efficient. And so you can, at some point, I guess, just add more things on your plate from other businesses, right? Yeah. And then maybe hire other people to take care of certain things you already mastered in the other business, right? Do you think that's kind of where the world is going?
I would love to see that. Unfortunately, the way the world is going now is that entrepreneurship, at least in the United States, I don't know what it's like in other countries, but in the United States, it is at a 50-year low. So we have far fewer companies created today and in the past 20 years than we did in the 1960s, 70s, into the early 80s.
Wow.
And we have much more dominance of almost every economic sector by a few monopolies. And this is why I think if you're an entrepreneur or an investor, you should care deeply about antitrust law. And you should be trying to fight against monopoly power and monopoly ownership. The private equity sector and the, multi-billion-dollar conglomerates that own huge amounts of sectors. Think about what Google or Alphabet does on the internet, right? Google Maps and YouTube and Google Hotels and Google Flights and Google Finance and Google News and the Google search engine and the 50 other businesses that they've got. They are all sucking the oxygen out of potential entrepreneurship opportunities. And I think it would be really beautiful to see a world in which the federal government was enforcing the existing antitrust laws that we have in a strong way and creating opportunities for small and medium businesses to flourish and begin. I'm in favor of this when it comes to tax law as well, right? I don't totally agree with everything around QSBS, but I'll admit it's kind of great for me and it's great for my investors. And I would love to see more people be able to raise money because of that. I'd love to see the UK initiate something similar. I know that there are programs in the UK that are fairly supportive of startups around taxation, but I think these policy things make a huge difference. And the big problem in the United States is that for the past 50 years, very wealthy people have funded almost all of our political campaigns, and they expect quid pro quo. Unfortunately, they've gotten it. They have benefited massively from the way our government has changed policy. And I think that's going to have to reverse if we want to see more entrepreneurship flourish, especially small and medium businesses.
If I look at the amount of how do I get rich YouTube videos, I think that's at record high. And I actually generally thought there are way more entrepreneurs nowadays than they used to be. But it's really interesting what you're saying about the big platforms. Yeah, and I mean, I agree, right? Like I think like in some other countries, you have even a higher concentration of platforms owning basically everything in the digital world. So the US is almost like still more fragmented than some other places on the planet. But of course, that doesn't mean it's good, right? It can be so much more fragmented, which would help way more people build.
Yeah, and we're obviously not just talking about tech. If you go back in time 50 years, every single city in America had 10 different ticket brokers, right? Who'd sell you tickets to concerts and, promoters who'd put on boxing matches and sports games. And now we have one. Ticketmaster owns the whole stack in every city across the entire country. And that's why if you want to take your kid to go see Taylor Swift or Beyonce, you better be willing to pay $2,000. The artist is going to get $100. The venue is going to get $100, and Ticketmaster is going to get $1,800. And that's because they're a monopoly. And so they can extract rent style payment, right? And everyone in the United States hates this. Like, there's nobody who doesn't work at Ticketmaster who thinks this is good. Mm-hmm. But unfortunately, because antitrust law hasn't been enforced, you get this problem. Credit to the FTC who's suing them now, but it's a huge problem that goes across every single sector and just takes a lot of room out of the entrepreneurship world. So when it comes to a policy perspective, it really does have an effect on all of our lives. Mm-hmm. And I think it would be a beautiful thing if, government policy and individual investors and individual entrepreneurs sort of recognize the macro environment they're in and said, hey, I'm going to start companies that have less competition. Mm-hmm. I'm going to invest in companies that have a higher odds of surviving profitably for a long time. And government said, we're going to try and enable that. We want to see more of that, because a healthy economy and a healthy political system happen when wealth starts at the bottom, right? When you build up a pyramid of wealth rather than the inverted pyramid that we have now.
Yeah, 100%. Great. Maybe final point, how can people reach you? Obviously, you're really big on LinkedIn. Any other source and place you kind of hang around?
Yeah, I actually, I know Meta owns everything, but I've moved over to Threads from Twitter. Threads is a really wonderful, nurturing environment. They're very good about banning Nazis, which is nice. And so if you want to follow me there, I use my wife's name, Rand de Ruyter, on Threads or on Instagram. And on LinkedIn, I'm Rand Fishkin. You can also email me anytime, rand@sparktoro.com.
Amazing. Thank you so much, Rand.
Yeah, my pleasure. Thanks for having me, Alexej.
To finish off this episode, a little promotion from our end. Neoptima is an award-winning marketing agency for B2B SaaS businesses. We work with companies backed by YC, Sequoia, Carlyle, Lightspeed Ventures, Northzone, and many other top VCs and PE investors. We work with venture-backed, private equity-owned, and bootstrapped SaaS businesses all around the world. Reach out to us and book a call in the description below so we can optimize your growth journey. If you have a fellow founder, if you have a team member, if you are part of a Slack group, Telegram, or WhatsApp group with other founders that could get value from this episode, please share this episode with them. We want to help as many founders as possible to scale their business. Thank you for joining us on this journey. See you in the next episode.